Welcome to today's webinar covering cash flow essentials for construction leaders. We're going to wait a few seconds to let some more attendees enter in. But before we do get started, there will be poll questions that pop up. So if you guys could answer them to the best of your ability, we would greatly appreciate that. So we only have 30 minutes for today's session. Also, if you guys have any questions, drop them in the Q&A. We'll circle around to those questions at the very end. So no question is a stupid question. So feel free to drop anything in. We just don't want to make sure anyone thinks that we're ignoring questions. We just want to do it at the end just to respect everyone's time. So
John is always very interested in the poll results and the questions, so don't
I
hold back.
know we've got a good one coming in hot. So all right, I think we can get started.
Okay.
All right. Before I give a quick run through on what we'll cover, there should be a poll question that'll pop up. It's what are the biggest cash flow challenges your business faces? We're just fascinated to hear what you guys have to say. So we'll share the poll results with them too once we get enough answers collected. So, but if you guys can answer that, we would appreciate it. What will be covered today, revenue recognition, what it is and why it's important to know, over and under billings, examples, common causes, best practices for identifying when it occurs, and then also managing your cash flow, AR, AP, your cash flow forecast challenges that everyone faces, such as the ones that you guys are seeing in the poll that's popped up, and also tips and tricks to getting paid faster. So I know no one's here to hear what I have to say. So everyone's here to hear what Mr. Paul Atkinson and Kevin Bright have to say. So I'll let Paul introduce himself.
Thanks, John. Yeah, as the slide indicates, I'm a partner with Smith & Howard and been serving the construction industry for over 25 years. Smith & Howard is a top 100 accounting firm in the nation. We were founded and are headquartered in Atlanta, Georgia, and now have offices in Dallas, Texas, Chattanooga, Tennessee, Richmond, Virginia, and Chicago, Illinois. So our family of companies provide assurance and tax services, along with consulting and advisory services in numerous different verticals. I look forward to spending the next 30 minutes with y'all, and I'm going to hand it over to Kevin.
Thanks, Paul. Yes, my name is Kevin Bright. I'm the product manager over here at ProNovos. So I see all of our product development efforts, our feature improvements. So before coming to work with ProNovos, I actually come from the construction industry. I spent about 7 years doing project management for a commercial contractor out here in California. So yeah, really excited to be talking about cash flow today with you, Paul. And John, I think I'm going to end the poll and let's see if we can share the results. And John, I think we were accurate before we started the webinar today. We said, what do we think is going to be the most popular response here for challenges? Our money was on slow payments, and I think that's what we're seeing from the poll results here. So let's go to the next slide. So we're actually going to launch another poll here for everybody. Let me see if I can go to the next one. So it's going to be a question in terms of what drives earned revenue according to GAAP. Is it going to be invoicing your client, aka project billings? Is it going to be the incurred cost on projects? Is it going to be based on your AIA billings, your schedule of values? Or is it going to be based on the actual cash received that you get from your clients? So we'll give everyone just a few seconds to answer the poll question here, and then we'll kind of share the results and go from there. Right. Okay, so those of you that said project incurred cost, you are right. Revenue is determined by percent complete, which is cost divided by projected final cost. So obviously we're here to talk about cash flow today. So why are we talking about how revenue is recognized? And I think this is a really important distinction to know that in construction, revenue, billings, cash received, while they're all linked together, they are very different and distinct things. And understanding that interplay between each, it can really give you an advantage when managing your cash flow. So let's take that first concept, revenue. So to recap, revenue is going to be calculated based on your percent complete. Once you kind of calculate that percent complete, you then multiply it by the contract price to get that final revenue amount. So Paul, I'm kind of curious from your CPA background, what are some of the things you see with contractors when it comes to revenue recognition?
Yeah, and we're going to get into the details of this a little bit further in the presentation, but obviously the biggest variable in that calculation is those projected incurred costs. So that's where there has to be significant time put into this on a monthly, if not more frequent basis, to making sure we're getting to those accurate numbers to have those project incurred costs and considering all variables that could go into that. As well as potential change orders that could be affecting that and driving those numbers as well. And that could be also part of the consideration on our contract values when we get into the calculation on the contract price. What are we including in that number to making sure we have apples to apples when we're doing that calculation?
Yeah, I think that's really well said. And I think what you said there that's really important is it's because of how revenue is recognized, what's really crucial is you have to have that accurate project forecast, right? Let's go back to that equation, percent complete, it's cost divided by projected final cost. You know what your costs are going to be. That's kind of an objective fixed thing. That projected final cost, though, typically it's going to require some analysis and there's going to be some subjectivity to it. So making sure that you have an accurate projected final cost, it's really important. Otherwise, you risk understating or overstating your revenue during the project, and you have to fix it later on. So let's look at like a concrete example of what that might look like. So here we have a project where we actually started with a 28% profit margin, and we actually finished with a 34% profit margin. So objectively, a really good financially successful project. But if we start to look at how the revenue and profit was actually recognized month over month, what we see is in April, there's this unexpected negative profit that happens. So how does this happen on a project that has such a healthy profit margin where we actually see in some of the months we have a negative profit? And if we start to dig more into the details, what we can see is the projected final cost increased from March 2017 to April 2017 by $118,000. So what that means is our percent complete is not the 96% that we said at the end of March. It's really only 89%. So that means we previously overstated our revenue. We then need to write down our revenue to correct it to be the right amount, which means we have a negative revenue in the month of April. And then that's going to correlate to a negative profit for that month as well. So Paul, I'm kind of curious, what are some of the challenges that you've seen contractors face when it comes to forecasting their costs for that revenue recognition portion?
Yeah, and I think part of it is where they're not significantly or not timely looking at those projected costs, as I referenced earlier. I mean, they're setting it at the beginning, and then not until they get closer to the end, where this one was 96% complete, or so they thought that it was, and they're now looking at the contract and realizing, oh, we still have significant costs to go to be able to finish this project out. So if they're not looking at this timely, what has been incurred and how much more they have on specific line items within the project, they're just, again, going to get towards the end more frequently than not and get to a different answer from when they originally thought.
Yeah, and that's what we see. Like the best contractors, they're going through this exercise of updating their forecast at minimum once a month. I mean, if you're really on top of it as a PM, maybe you're looking at it even weekly or bi-weekly as you're having your labor forecast hit. So yeah, I think that's a really great point. Okay, so let's kind of move on. So let's go back to those three distinct concepts, right? You've got revenue, billings, and cash. And let's look at how revenue is going to be kind of correlated with billings. So we talked about how revenue is calculated. It's obviously going to be correlated with billings. It's going to inform what you bill on a project, but those aren't going to be one-to-one, obviously. And that delta represents our over or under billing on a project. And knowing the over or under billing on a project tells you a lot, but more importantly, understanding what's driving that over or under billing on a project can really tell you a lot about the health of a project. So Paul, I would love it if you kind of give us just a quick synopsis of what underbillings are.
Right. So, and I think we had it on the sheet earlier, or here it is on top of the sheet here, is that so when you have earned revenues that are greater than your amounts billed, you have a contract asset on your balance sheet or a receivable, if you will, for unbilled work that has been performed. And so generally speaking, this is not the good situation to be in, because this will then even further negatively impact your cash flows. Because if you perform the work and don't and even haven't billed it yet, that cycle, which we'll see here in a minute in the calculation, gets slowed down even further. And then you can see on the slide here some of the reasons there that are cause for those. Again, poor billing practices, unapproved change orders. So you're incurring all these costs without the ability to get those approved ultimately and then get those paid for. And so that's not a good habit to get into. And then again, cost overruns, and then your costs are just too low. So if you have a percentage where you're calculating a percentage that shows that you're much further along in the project than you actually are, because you have an estimate that's too low that would drive that percentage down, then you're just going to calculate to have an underbilling situation. Now, so with that being said, is not all underbilling situations are leading to where things are negative. Sometimes it's just the nature of the contract. We see a lot of time and material contracts where you have to do the work first and then be able to bill it at a later point. But then that just further emphasizes the quickness of billings that need to be done, so you can kind of get those billings into the cycle and get the cash collected to be able to pay for those costs that have already been incurred.
Yeah, no, I think that's well said. I mean, like you said, there's a lot of different reasons that you can be underbilled. So kind of understanding what it is it because you're going to be going over budget? Is it because you're missing change orders? Is it because you're just slow on billings, or is it just the nature of the contract? I mean, it can really tell you a lot. And kind of going hand in hand in that, let's talk about the more positive scenario. What does it mean if we are overbilled on a project?
Yeah, so essentially it's obviously the opposite situation where you've billed more than what you've actually earned from a revenue perspective, which again, from a cash flow perspective, billings, you're starting the process. Just because you billed it doesn't mean you're actually collecting it, but at the same time, you've actually started the process sooner from when you've incurred the costs. So again, it allows the owner, once you bill it and then collect it, to them to kind of help front load once you get the cash in to be able to pay for those costs that are going to be incurred. But from an overall math perspective, again, when you look at what the projected number could be, is if your projection is too high from what ultimately is going to be incurred, then you're under recognizing revenue potentially to be able to get to that final calculation from what the revenue is ultimately going to be earned. So which is a better situation to be in than underbilling and having your cost too low on your projections. But at the same time, you don't want to have too much of a significant pickup at the end, because again, for various reasons, you want to kind of be as accurate as you can along the way. But it's better to be an overbilling situation than underbilling situation at the end.
Yeah, it's funny you say that. One of my first bosses in the industry used to tell me when I was significantly overbilled on a project, and then we had this big pickup in profit at the end, he would always tell me, it's like, well, you just got lucky. If you actually knew that was going to be the profit, you would have, told me 6 months ago. So you got lucky in a good way this time. You could have just as easily got lucky in a bad way next time. So I think that's a really good point, that just because you're overbilled and it means you might pick up something from a profit standpoint, you want to kind of recognize that as early as possible.
Yeah, and we tell our clients that it's good to be in this situation, but you can to be conservative, but you can still be conservatively wrong. And so if you're way too far overbilled because you're just going to have a massive pickup at the end, again, to your point there, Kevin, about you lucked into it potentially at the end, or you knew that was going to happen. And so if you knew it was going to happen, then let's make that information accurate so you can plan accordingly, not just for this job in particular, but how that relates to the overall performance of the company as a whole. Because you might have jobs, maybe other jobs that aren't doing as well. And so, if the cash flow needs could kind of help support those other jobs from a company's perspective, you'd want to know that, right? If you had additional profit to be able to utilize, company-wide.
Exactly. Yeah. So yeah, let's kind of bring it all together here. So like Paul kind of alluded to, so revenue doesn't equal billings. Overbillings is when billings exceed revenue. Underbillings is the opposite. And here's where we start to kind of fold in that third concept of how does this kind of relate to the actual, what we're here to talk about, the cash flow and cash received. And Paul mentioned it. If you go and ask any contractor, what are you going to want to be, underbilled or overbilled on a project? Everybody wants to be overbilled. And the reason you want to be overbilled is because that's going to happen, or it's going to help you with with your cash flow on the project. So I think that's something we all kind of intuitively know, but let's take a look at a project example to really articulate that point. So here we're looking at the billed amount versus the cash received versus the cost on a project. And what we can see is we actually build the project in the very first month of the project, even before we had costs. We didn't have costs until the second month of the project. And throughout the entire duration of the project, we can see that our billings pretty consistently outpace our costs. So this is a project that was handled really well from a billing standpoint. But if we start to look at what that actually means from a cash received standpoint, it's a very different story, right? We can see that our cash received doesn't actually exceed our cost until almost a year into the project, right? Our first billing was in May 2022, and our cash didn't catch up to our cost until May 2023. So even on a project where we're really on top of our billings are significantly outpacing our cost, it can still be very difficult to get to a healthy cash position until very late in the project. So why is that? Well, there can be a lot of reasons, but typically it boils down to these four main reasons. The first one, like we kind of all said in that initial poll question here, clients are slow to pay, right? Construction is a notoriously slow industry to pay. In theory, all contractors should be getting paid within 30 days. I don't know anybody that actually gets paid in 30 days by all their clients. I think it pretty rarely happens. Much more often we see 45, 60, 90 days to get paid by your clients. The second one is kind of just the nature of how billings are done in construction, right? You typically only bill your client once a month, but you typically are going to have your costs hitting your project every day, every week. So there's that discrepancy in terms of the frequency, in terms of which you can bill, in terms of, or compared to when your costs are coming in. Third one is pretty straightforward, retention, right? It's kind of just another thing we have to accept in construction, but it's really difficult from a cash flow standpoint, right? You're right out of the gate, you're kind of starting at a 10% disadvantage from a cash position on your projects. And then finally, you might need to pay out your costs faster than you are paid by your client. So this is going to be really important for contractors that do a lot of self-perform, right? That payroll, those labor costs, those are going to be going out every week, even though you may not be getting payment from your clients in time. So Paul, I'm kind of curious if any one of these particular challenges that you wanted to elaborate on, or if you see some other ones that contractors are facing out there.
Yeah, no, I think you hit them all. I mean, this, the cost per side of it, and when costs are going out, that's the known, and that's cash flow out the door. And so if you can control that as best you can, if there's a paid when paid situation to kind of minimize that from a cash flow perspective, that's good. But it's sometimes labor and things of that nature, you can't not pay labor. And so a lot of times if you're a labor heavy business, your cash flow outflows are going to be more significant, especially up front.
Yeah. So let's kind of dive into this a little bit more, and let's actually compare kind of what the cost and billing cycle looks like on a project compared to a cash flow cycle. So let's take the cost and billing cycle first. So we're just going to use kind of some basic numbers as an example here. Let's say on the first of the month, I get a material delivery that is $50,000 in cost. So I start the month $50,000 in the hole. I then have my labor cost for the first week. Let's say those are $10,000. I am now $60,000 in a hole when I compare my billings versus cost. I then have my second week of labor, another 10K. I'm $70,000 in the hole. But then good news, we get to the middle of the month, I can bill my client. I bill 100K. I'm now plus 30K when I compare my billings to my cost. And then that's basically going to cover my labor through the rest of the month. And I finish at a plus $10,000. So what we see here when we look at just billings and cost, you might start off from a kind of a tough standpoint, but you can catch up really quickly. Now, if we compare that to the cash flow cycle on a project, that is a completely different story when we start to look at what does it look like when cash is going in and out of the door. So the first thing we're going to have going out the door, right, is going to be those labor costs. You got to pay your people every week. So let's take the $10,000 we had for the first week. We're $10,000 in the hole from a cash flow standpoint. Labor for the second week, another $10,000. Third week, fourth week. We finished the first month, $40,000 in the hole just from labor. And then that material delivery that we got on the first of the month, we likely have net 30 terms with our vendor. So now we need to pay them. So now we're $90,000 in the hole. We roll into month two and our labor costs start to stack up again, $10,000 every week. And very quickly, we're 100K, 110, 120, 130 down in the hole. And then finally, we get to the end of month two, and let's say our client optimistically pays in 45 days, we're finally getting that payment that we invoiced for in the middle of the first month. But to add insult to injury, we're not even getting that full 100K. We're only getting 90K. So even once we get that payment, we're still $40,000 in a hole from a cash flow perspective. So just comparing the two again, you can kind of see, you know, if I look at my cost and billing cycle, I catch up real quick. But when I actually take those exact same activities and correlate them to what that means from a cash flow cycle, very different story. So Paul, I'm kind of curious if you can kind of elaborate on some of the implications from a business and financial standpoint of what this means, that if you're having to always operate from this cash deficit position.
Yeah, so obviously you have to have a cash surplus, you know, from the business as a whole to be able to be in a negative cash flow situation on a particular job, or you have the ability to borrow to be able to fund those jobs if, you know, collectively there's the cash on the balance sheet is not significant enough to be able to carry the cash flow needs. And so, you know, with the age we're in, you know, this recent year or so with rising interest rates, maybe coming down a little bit now, but still, you know, a lot higher than they were several years ago. And so your carrying cost is going to cost you additional monies the more negative cash flow you have, because you're having to pay interest, potentially, or losing out on interest, earning interest as you carry the costs associated with these projects.
Yeah. No, I think that's well said. It's you know, it's expensive to be running from a cash flow deficit, not only from the day-to-day, but also kind of, you got to make up that shortfall somehow. And those options typically aren't cheap to do it. So, okay. So what are some of the strategies that you as a contractor can use to mitigate some of these demands on cash flow? And if we go back to what the main challenges were, you know, billing once a month, clients are slow to pay, retention, you need to pay your costs faster than you're paid. It basically boils down to how you manage three distinct processes: how you manage your billings, how you manage your collections, your accounts receivable, and how you manage your outflows, AP. So let's
Hey,
take
Kevin,
billings.
can I add something real quick
Yeah,
to that?
absolutely.
We go back.
Yeah.
So one thing on the managed billings perspective is a lot of times I see is the accuracy of the billings. And so, you know, we'll see a lot of times our clients will do the best job they can as far as, you know, bill frequently, but the accuracy of the billings not right. And so when they send it to the GC or the owner of the project, you know, they'll kick it back and say, hey, no, this is not right, and so on and so forth. And so it almost starts to cycle over again. And so making sure that you have a process in place to have, you know, accurate billings go out on a monthly basis is really the key to that. So it's almost an asterisk that you need to make sure that, you know, that's part of the strategy when you go through the process.
No, I think that's really well said. And if we start to actually consider what are some of the strategies we can use to help manage the billings, that first one that you just kind of talked about, Paul, I think that's such a simple thing that we see a lot of contractors miss. Here at ProNovos, when we look at our clients' data, it is shocking the number of times that when you just look up, hey, what are the projects that you had costs on in this month, and did you submit a billing to your client? A lot of times there's are ones that are getting missed, right? Maybe it's like, oh, we weren't that active on the project this month, I don't need to submit a billing. But then if you actually look at your cost, you're like, oh, I still got my rental equipment, I got GC or general conditions costs coming in, and that actually added up to $20,000, and I should have submitted a billing for that. So making sure that you are billing all of your projects in any given month, really important. And having a chart like this that kind of gives you a breakdown by project manager and tells you, hey, if Nash has 10 projects and he's billed 9 of them, what's this one year that he didn't bill in the month? It's a really good way to kind of make sure everyone's dotting their I's and crossing their T's. So that's kind of one of the first strategies that we always recommend for contractors is one, very basic, just make sure you're billing each month. The second one is you should really be strategic in terms of how you create your schedule of values. Where you want to be increasing the value of the schedule of values that are going to happen earlier in the project. So it's going to create kind of a natural overbilling in the project, right? So there's always a little bit of art that goes into creating your schedule of values, and you're going to have some flexibility when it comes to your general condition cost or your profit in terms of which line items they go into. So really try and kind of front load it as much as possible so you can kind of create that natural overbilling cycle into your project. The third one is really make sure you're tracking your cost, right? I think, like I said, we see billings can be a lot of an art as much of a science. And when you're doing it as much of an art, you might just be kind of going thumbs up like, hey, I think we were 20% done on this line item here. Actually look at your cost to understand, okay, What should we be billing based on the percent complete? And equally important, make sure you're forecasting that through the end of the month. So if your billing is due on the 15th, make sure that you're considering what your costs are going to be from the 16th to the 31st, because this is going to be your chance to make sure that you're paid for it. So make sure you're including that in your monthly billing as well. And then the last one, be aggressive. I mean, it's kind of just the nature of the beast. I used to have one boss that used to tell me, hey, if you submit a pay app to a client and they don't reject it out at least once, you're not being aggressive enough. So like we've kind of said, there's as much art as there is science to billing sometimes. So use that to your advantage. Really try and be as proactive for billing everything that you can on a given project. Paul, anything you wanted to add in terms of strategies when it comes to billings?
Yeah, so this was kind of sort of as far as from a billing strategy is actually a cost and recording. So you mentioned about making sure you're projecting as far as what costs are going to be incurred that month is, you know, I've seen or heard stories of project managers sitting on invoices and not approving them and not processing them in that. And so, you know, next thing you know, 15 days or a month goes by and, you know, something potentially hasn't been input. Now you get a call from that vendor or whoever that is saying, hey, how come I haven't got paid yet? And so now you haven't billed for it, and now they're wanting to get paid even quicker potentially. So again, that's a strategy to making sure that, you know, we get our costs in time as quickly as possible, just to making sure. So that's another incentive of those project managers. You know, they might be trying to delay the process from a cost perspective, but at the same time, it ultimately is going to come back to them if we don't get those costs in, recorded timely.
Such a good point. And that's especially if you have a lot of subs on a project, make sure you stay on top of them to getting their billings to you. I know back when I was a project manager, nothing drove me crazier than if a sub submitted me a billing like 2 days after the cutoff with with our client. It's just like, okay, well, now I need to have you wait another month, and then it really just puts a strain on the relationship. So yeah, stay on top of your subs, make sure you get all those costs in. Okay, so the second one, managing your AR and receivables. So in many ways, billing clients is the easy part, right? The hard parts now is getting them to pay. So as we talked about construction, it's a notoriously slow industry to pay. So one of or a few different strategies you can use here is one, consistent follow-up with clients. So at ProNovos, we actually have a system that sends notifications to clients asking for updates on invoice statuses. And it's a really simple thing, right? But a lot of times, you know, the squeaky wheel gets the grease for a reason, right? So just kind of checking in with your clients, making sure that they're approving the invoices on their end, nothing slipping through the cracks, really goes a long way. Second one is knowing the payment habits for your client. So if we look at this chart here, here's an example of one project where we can see on average, this client is paying in 94 days. But if we actually look at the individual invoices, we see there's a lot of variability in terms of how quickly they're paying. On some invoices, it's taking them a crazy 140 days to pay. Other times, you know, they're more around 75 days here. So if you know this and you say, hey, they sometimes take 140 days, sometimes they take 75 days, use this information and this data to your advantage and follow up with the client and say, hey, what do we need to do here to make sure that we're getting paid on the shorter end of the spectrum? Third one, negotiate an early reduction in your retention. So this is something I always encourage you to try and do when you're negotiating your contract. If you can, try and get a clause in there that says when you are 50% complete, you can reduce your reduction down to 5% instead of the standard 10%. And then the last one, protect your lien rights. I mean, at the end of the day, that's going to be your last kind of legal defense to make sure that you get paid by your clients. Don't let those lien rights expire without you realizing it. In particular, make sure you're really kind of dialed in, paying attention to any invoices that are 90+ days aging. But yeah, those are some of the strategies you can kind of implement to help you with collection. So Paul, any thoughts in terms of what contractors can be doing when it comes to AR?
Yeah, no, I mean, keeping on top of this is critical. I mean, because if you get to a point where, you know, you've gone 2-3 months, you know, the potential from a bad debt perspective ultimately becomes where if you can't get collection, ultimately, you know, it just becomes a bigger problem over time if you don't monitor this and get paid as quickly as possible. Just not for your own internal, just cash flow timing, but just the ultimate cash flow as a whole. So you just want to make sure that you're not getting too far ahead where you're ultimately not going to get paid, not just the timing of it. If it's a never perspective, then that's even a worse scenario. So, you know, this would help you monitor that to making sure you're not getting too far out where ultimately you could, you know, end up in a loss situation because of that.
Yep. Okay, and then the last one is your outflows. So this is going to be the most straightforward. Let's break it down by different types of outflows. So, right, first one, you've got labor. Not a whole lot you can do about that. You got to pay your people, right? Pay your people on time. So not a whole lot you can do in terms of managing your payroll and your labor outflows. Next one is kind of your material, right? So material and equipment for that matter. So with your vendors, you're typically going to have net 30 days, but I highly encourage every contractor to go look at your data and identify those vendors that you do the most work with. And more likely than not, you might be able to negotiate better payment terms with someone. Maybe you can find some that are willing to go to net 60 if you commit to doing a certain volume of work with them every year. So that's another thing you can always look at. But the biggest and most important one is make sure that all of your subs are paid when paid. That basically you are not contractually obligated to pay them until you receive payment from your client. So like I said, outflows, it's going to be a little more straightforward than billings and AR, but those are just some things to track when you're considering your AP and outflows. And then I guess kind of the last thing when it comes from managing your cash flow as a contractor, as a business, is you want to bring it all together and create a cash flow forecast. So this is taking your inflows, your outflows, your current trial balances, and creating a cash flow forecast. So there's nothing worse than when you're tight on cash and payroll is kind of staring you down. So don't get caught off guard. More contractors go out of business because they run out of cash than because they don't have a lot of work. And cash flow problems are really hard to solve, right? And it's going to be even harder to solve if you're on a small time frame. And like Paul was kind of alluding to, they are expensive problems to solve these days if you have to go find money to borrow or loan. So make sure you're really staying on top of it. Make sure you're doing a 13-week cash flow forecast. You kind of know what's coming down the pipeline for you as a company. But yeah, that's I think that's the end here. Paul, I'll kind of give you the last word if there's anything you wanted to say about cash flow when it comes to construction.
I mean, I think we've covered a good bit here in the last 30 minutes, and I think we've got it all. But I mean, there's a lot to monitor, right? I mean, so you're looking at monitoring your billings, your costs, and then your cash flow management, the ins and the outs. And so the part of it is just having access to data. And that's one of the great things about ProNovos is it gives you access to data immediately to be able to, see that information in real time and not wait 30 plus days to get that financial information out of your system accurately to be able to kind of know what's going on. And so that's what I love about the product, and it just kind of helps us get to that point.
Yeah, and here we get to the shameless plug part of the webinar. So if you like kind of what you saw during the presentation today, a lot of the examples, the data, the visuals were created using our platform here, ProNovos. So if you're interested in learning more about it and how you can leverage ProNovos to help you manage your cash flow, update your project forecast, and really just use your data better, we'd love to talk to you. So I'm going to launch a poll right now if anyone is interested in a demo request. And John, I'll pass it back to you.
Yeah, it's noteworthy for the demo request for select ERPs and accounting systems. ProNovos offers a data demo sync of your data back to you so you can see it in the financial intelligence tools that Kevin was referencing during this presentation. That includes the cost forecasting tool, AR collections and management, and the dashboards that went with it. And like Paul mentioned, ensuring that the bills that are going out are accurate so you can avoid delays or getting them rejected in the automated follow-ups. So with that, I see that we have one question in the queue, and that is it was asked halfway through the webinar. So Kevin, you might have already answered it, but maybe we could circle back to it. And it's what are KPIs that we should closely monitor to detect early warning signs of potential cash shortages or impending challenges?
Yeah, so I'll throw out two. So over under billings is always a good one. If you have significant under billings on projects or collectively, that's usually a pretty big warning sign. And then the other one is look at your AR aging. If you have a lot of invoices in the 90 plus aging bucket, that's usually going to be a pretty big red flag from a cash flow standpoint. So Paul, I don't know if there's any others you wanted to throw out there.
Yeah, no, that's good. Yeah, looking at your aging to making sure that you're keeping that current or as current as you can, and then also just company wide is just looking at how much cash you need to have cash either on the balance sheet or availability to cash, meaning borrowings, availability on our borrowings under a line of credit to be able to kind of manage. So as you're growing and kind of getting those jobs off the ground, a lot of times from a cash flow need, that's all up front. So if you're significantly growing, got a lot of projects going on, your cash outflows are going to significantly outpace your cash inflows. And so having that availability to cash is critical to making sure that you don't get to a situation where you don't have enough cash to be able to kind of keep those jobs going.
That's such a good point, Paul, and I wish we touched on it earlier. Usually when we see contractors struggle from a cash flow standpoint, it's not always when business is slow. It's actually in those periods of rapid growth, right? Because you've got to kind of finance the jobs before you're going to get paid for them. So having a good revenue forecast and saying, okay, if we are going to go through this growth period, do we kind of have the cost on hand or the cash on hand to handle it?
I see a question just popped in. How do you all handle large MOH at the beginning of a project? It usually generates a huge underbilling.
Paul, I'll admit, I'm not sure I know what the abbreviation MOH is. Do you?
I don't think I've heard that acronym.
Whoever asked that, just provide the abbreviation. That would be appreciated. Materials on hand.
Yeah.
Right.
So I'll speak to this because I used to have some experience with this firsthand. Some of the projects I used to work on, we had very large material buyout early in the project. And what we would do is we would do our best to negotiate with the clients that we would actually have a separate line item in the schedule of values that said, 50% material deposit or something like that early on in the project that we could bill for. So I don't necessarily think if there's a financial mechanism, but I think it's really good to kind of at least have that conversation with your client early on, and in particular, if you can kind of define a line item for it on the schedule of values that you can bill for early in the project, maybe before you step foot on the job site. That's one strategy I've seen that's been pretty successful.
Yeah, and then just to layer onto that a little bit, just from an accounting perspective, as far as, if these are store materials and such, that, the rules have changed a little bit on that as far as, you actually can't cost it to the job technically to be able to kind of say that's an incurred cost. Now, from a cash flow perspective, you still are spending the money, but from an underbilling situation, you might not actually technically be underbilled on the job because of the fact that you haven't costed those materials to the job. But the premise is still the same, right? From a cash flow perspective, is making sure you can kind of put in the contracts to be able to get paid for that cost, so you're not out of pocket. But again, a lot of times, the reasons you do that is you buy it out and try to get the best price possible, and so it's advantageous to do that up front. But again, it's just you just have to have those cash availability to cash to be able to make that happen, to kind of sit on those store materials.
I see Denise added, recognizing the revenue such early on causes problems for us, especially tax wise when it crosses years. So I know, Paul, you focus on audits, and Smith and Howard has a tax hand, but if you had any insight.
Yeah, Paul, you get the tax questions.
Yeah,
Well,
we'll
I
pass it to
wish I
you.
could pull someone in from my tax team to be able to probably accurately answer that. But it's there's a fade and look back analysis that is done, and a lot of times so if you're too aggressive on your profit margins on a job where you think you're going to make, let's say 20%, you cross over at year end and you're on a percentage completion for tax as well, you're having to pay profit or pay tax on that profit. Now, if the job ultimately ends up and you only earn 5%, so you prepay taxes on that project that ultimately didn't happen, right? Or those profits that didn't happen. And so you technically can get some interest back, but again, I'd rather have the cash than the interest at the end, right? As far as having to not pay those taxes. So that's a good point as far as the accuracy of the information as you go, to make it as accurate as possible. Now, going back to the other thing on the fade on the end, you would have to actually pay interest on some of those on that look back if it was significant enough from, sandbagging it, if you will, until the very end. And so it kind of goes both ways, but it's just, again, I try to encourage our folks to be as accurate as possible because it's ultimately the best way to do it.
Well, I see that we ran 8 minutes over, so we can wrap this up. So we'll be sending the recording of today's webinar along with the slides and a couple links to some relevant sources that ProNovos has produced as soon as all that stuff becomes available. So you can probably expect to receive it all probably by tomorrow. So I want to thank Paul for giving us his time, and Kevin as well for today's presentation. So I hope everyone has an enjoyable holiday season.
Thanks, Sean.
Later, guys.
Thanks, Kevin.
Thanks, Paul.
Mm.